recording.
Is that Barbara joining us? Hi, Barbara. Can you hear me? Okay, so you'll be a silent participant. Okay, glad to have you aboard. Maybe just wait a moment or two and get a few other participants. I'm waiting for a couple of regulars who normally join us, Barbara. What I'm going to do here is go through chapter 10. Last Thursday, we went through chapter 9 on present value and debt financing, if you will. And today we'll go through some PowerPoints on bonds and more present value. Have a couple of Excel examples we can work with. Glad to answer any questions. Where do you work, if I might ask? I think you're back now. Your name just flashed up again. Hi, hey, we have a new one. Hi, Callie. Hi, Callie, how you doing?
Yeah, good. Hi.
Good. Did you do those component percentages? Finish those. Thank you. I saw that. That was partially my fault because the first template I sent out was not quite right, and that was my bad. Okay, we've got Barbara with us, who's going to be silent. She's at work. Here comes Brad, and he's always silent too. Where's Kate? We're missing Kate, right?
Yeah.
Okay, we'll get going in just a moment here. Make sure Brad's with us. Hi, Brad. You all with us now?
Yeah, I'm good. Thanks, Bob.
All right, and Brad, you're going to be in hiding as always, right?
Yeah, my webcam doesn't work.
That's right. You're the guy with that. Okay. All right. With no further delay, let's get going here. Okay. What I'm going to do is I'm going to put up the PowerPoint for chapter 10. Okay. Bonds is the name of the game. Bonds. And we are going to, and let me get this the way I like it. Okay. You can all see the PowerPoint now, right? Okay. Bonds. Let's understand what a bond is. It's simply a debt. A bond is a borrowing instrument. You borrow money from somebody and you're going to pay them back in one lump sum in the future, but you're also going to be making periodic payments. That is a bond. And there are rules about different types of bonds and how we amortize them. Okay. So here we go. You can raise money with debt or equity. You can issue stock to the world to raise money. And that's the area we're going to go into in the next chapter. In this chapter, we're a company, a big company probably, and we need to raise a big amount of money, and we're going to do it by issuing a bond to the public. We're going to prepare a prospectus, which is a summary of what the bond is all about. We're going to announce to the world that we're Coca-Cola, and we want to borrow $1 billion to build a giant factory in one of our foreign locations. So we say to the world, if you loan us money, we will pay you 5% of your interest, and then we'll pay you back in 10 years. That is a bond. It is an IOU. It is a debt, okay? Bonds, one way of raising business. We just said that you can raise money by debt financing, which is a bond, borrowing, or you can do it by issuing stock to the company, or of course, putting your own money into the company. Bonds, good and bad points. If you issue bonds to the world, well, you're not giving away part of your business like you are when you issue stock. It's not equity. You have a certain amount of control there. And also, when you are paying the interest expense, at least it's tax deductible, right? So I guess you can call that a slight advantage. And the impact on the money can be positive if you use it properly. They're saying here the impact on earnings can be positive. Money can be borrowed at a low interest rate and invested at a higher interest rate. And I don't think we needed this book to tell us that, huh? You borrow money at 5%, and you put it in your bank for 6%. It's a great world, huh? But if you issue a bond, you can put yourself out of business because you must pay the interest and you must pay back the debt, unlike stocks where you don't have to pay a dividend. Stockholders take a little more of a risk that way. You buy stock in a company and you like the dividends and they stop paying dividends, you have no legal recourse. The company can do whatever they want. Here, you have to pay and you got to repay it on a particular time schedule under severe penalties. Here are some terms about bonds. Bonds. In the old days, you used to get these certificates, like a stock certificate. A bond, this certificate is going to have two elements to it, okay? And this is what makes the bonds a little bit tricky, because when you're coming up with the present value of a bond, you have to come up with the present value of two things. You borrowed money at $100,000 to be repaid in 7 years. Well, at 5%, you have to go to your present value tables for that amount of years, that amount of interest, and that becomes the present value of that one future payment. But the bond has another element, which is the annuity portion. And we should know now from the prior chapter, an annuity is a regularly scheduled payment of the same amount of money at the same interest amount over a finite period of time. So if this is a 30-year bond at 5%, you'd have to go to your annuity table for 30 years, 5%, get the present value of the annuity, add them together, and that becomes your present value. And what you're going to learn shortly here is that becomes the amount of money the public will pay for your bond. Because even though you're trying to borrow $1 million, that doesn't mean you're going to get $1 million from the public. You might actually get more, and we'll talk about that. Bond terms, the principal, that's what we were just talking about. The principal, how much did you borrow? $100,000. That's the principal. You can call it the par value, the face value, the maturity value. It's the principal. The coupon rate is simply, and I want to use the word simply, the money that you're going to pay. The coupon rate is the stated rate, also called the nominal rate. It is used only for one reason, to calculate the payment you have to make every period. You borrow $100,000 at 12%, that's $12,000 a year. That is the cash amount. That's all the coupon rate does. You will never use the coupon rate with the bond present value tables. Let me say that a little more clearly. You will never go to the present value tables and use the coupon rate. Never. And that's a mistake that's easy to make, and I'm trying to get this class to try to avoid that little pitfall. Here's the trickier part now, huh? We're going to talk about something called the market rate, or more properly, the effective interest rate. This is the rate that other businesses are actually paying in the marketplace. And the market rate determines how much money you are going to get for your bond. For example, if you're telling the world that you're going to pay 5% and the rest of the world, the rest of the United States businesses are paying 6%, nobody is going to buy your bond because you're only paying 5%. Why would you go to another to you when the guy next door is paying 6? As a result, you're not going to get 100,000. You're going to get something less. And if the market rate is lower and you're offering more, you're going to get what's called a premium. Okay. Here's a couple of different terms. Good multiple choice questions. Some low hanging fruit here, huh? Indenture is the bond contract. It talks about all the legal ins and outs of the bond, how long it's going to be, what type of bond it is, what's the interest rate, how often are we going to be paying, that type of thing. Debenture, another word for it is an unsecured bond. It's just a contract. An unsecured bond. I come to you to borrow money, and I walk into your bank or your investment house or insurance company, and I say, I'd like to borrow $100,000, please. And you look at me, and you can tell I'm a good guy, and you say, here, Bob, here's $100,000. Just make sure you pay us back in 10 years. That's an unsecured bond. Unsecured because if I don't pay you back, you don't have much recourse other than to sue me, to come after me. But if you were smart, as soon as you saw me walk in, you know I'm a deadbeat. So when I say I want to borrow $100,000, you say, that's fine, Bob. I notice you're driving a very nice car out there. Hand me the title to that beautiful sports car that's worth $100,000, and I'll give you the money. And then you have some protection. If I don't pay you, you've secured the bond. You now own my car, and you can cash that in. Collateral is the word, collateral. Callable bonds, this will come up a little bit. Callable bonds. We borrowed money from somebody at 10%, 30-year bond. It's a callable bond. That gives us the right to retire it at any time by simply notifying the lender, hey, we're paying you back. Here's your interest up to this point in time. Here's a little bit of the penalty we have to pay. Goodbye. Callable bond works this way. You borrowed money for 10% maybe 8 years ago when the interest rates were higher. And over the years, as you probably all know, interest rates have gone lower and lower. You would be crazy to keep paying this guy 10% when you're able to pay him or her off and then redo the bond perhaps for 4%. Callable bond. Convertible bonds, I don't hear much about those anymore. I don't deal in them. I don't know people who really do. A convertible bond means you owe somebody $100,000 in terms of a bond. And you start to like that company. You think that company is a good investment. With a convertible bond, you can call the company up and say, take my $100,000 and buy a commensurate amount of stock in your company. In other words, you're converting it from debt to equity. Bond issuer, a prospectus, that's a little booklet that's put out when anybody raises money with bonds or stocks. Covenants, that's a fancy word for the rules of the bond, designed to protect the creditors. It's very clear. And the trustee is a third party that gets involved in issuing the bonds. This slide here we'll go over briefly. Let's understand that there's one word this chapter does not use in the world of bonds, and it's a very important word. That's risk. Risk. Right now, interest rates are terribly low. A major corporation like Coca-Cola, they could probably raise money easily by offering 2%. But if you like, and I'm serious, I can set you up with a company that'll pay you 12% today. Does that mean that's a good thing for you to do, collect 12%? Maybe not, because the only reason a company would pay that much more than the market rate is because it's a company that's in trouble. It's a company that's having trouble borrowing money. They may be on the verge of bankruptcy, or they're a startup, trying to come up with some new product or something. Risk is important. In our course here, though, it's to learn the fundamentals of the bond processing. Here we go. Here's a look at three different companies and three different businesses, huh? Bond prices are just like stocks. You can look them up every day. You can sell your bond today. You can sell it at any time. And the value of the bond moves like a stock. It goes up and down. The difference with the movement of a bond, it's pretty much solely due to changes in the interest rate. So let's take a look here. We have Apple, Amazon, Walmart. Apple pays 3.45%. Wow, that's pretty good. Amazon only pays 2.5%, and Walmart pays 3.3%. Okay, and then they're telling you when these bonds mature. The maturity date is when the bond period, the bond life ends, and you pay back the principal. Look at this now here. You now, with Apple, are able to sell that $100,000 bond today for $101,290. And the reason is they're paying more interest than these other guys. Here, Walmart, 101.36. They're actually a little bit higher. There might be some perception that they're a little less risky. And Amazon's only paying, Amazon, it's only worth 94.92. They're paying the 3.2. So the bond prices go up and down. The yield is how much you are receiving considering the value of the bond. Let's look at this here. Here's your bond certificate, huh? Bond payable. Question from somebody? I'm hearing somebody asking something. No? Okay. Bond payable. Here's your bond. This bond, we're borrowing $1,000 at 10%, and it's to be paid in increments of 6 months. So we're going to be paying 10%. That would be what, $500 every, whatever it is, every 6 months. Bond period goes from the 16th to the 26th. It is a 10-year bond. Okay. What is in here? The face value, that is the amount of money you are attempting to borrow. The face value, that's the principal, huh? The maturity date, the coupon rate, that's simply what you're paying in cash. And then they're giving you the dates when you're paying them. In this case, it's every 6 months, the bond date. And these are the two key, this is the key thing here, the market interest rate. And that market interest rate is going to come into play for the rest of the chapter. And it is the only interest rate you will access with the present value tables. And you'll make that mistake at first, and it's a very easy mistake to make. Let's understand this table here. Let's understand this. We need to understand this really before we go too much further. We have two elements to a bond, right? We borrowed the principal, $100,000, and it's at 6%. So the annuity is $6,000 a year, let's say for 10 years. To get the issue price of the bond, as we just said, you are going to take the market rate, whatever it's given to you, not the 6% we're paying, but the market rate, and you're going to go to the table and you're going to get the present value of the principal, which is the 100,000. You are going to get the present value of the annuity, which is the 6,000, I think I said. Add them together, and that becomes the issue price of the bond, meaning your debit to cash. Your debit to cash. So you're going to debit cash for whatever the market, whatever the public paid for the bond. You're going to credit bonds payable always for the 100,000, and any difference is called a discount or a premium. So let's take a look here. Stated rate, that's the coupon rate. Your stated rate, you're paying 6%, and so is the market. Well, that makes life easy. There's no difference to account for, and we're really done. But in the real world, there's going to be a difference. If your stated rate is less than the market rate, that means that no one is going to buy your bond unless you offer it at a discount. If the stated rate is less than the market rate, your bond price, the issue price, is not going to be 100,000. You're going to get 98,000 or whatever. That difference is called a discount, and that is a contra liability account, and it is an account to be amortized. And we're going to do some heavy amortizing in a little bit. On the other hand, if you're a generous company and you're paying more than the public is getting, the public will give you $102,000 for your bond. The difference is called a premium. That's a liability. Understand that at the end of the 10 years, you're going to pay back the 100,000, and you are going to keep making those coupon rate, stated rate payments. This, I'm kind of smiling to myself. I always find this thing a little bit confusing, but they're just repeating what you see on here. What they're saying here, if the coupon rate is 10% and the market rate is less, premium. If you're paying more, coupon rate is 10 and the market is greater. This is a very, very clunky slide. This is the one to look at right here. They're the same thing. Okay, you ready to do some journal entries? Do some amortizing? Here we go. Burlington Northern Santa Fe, the famous BNSF, issues $100,000 in bonds. Issue means that they're trying to sell $100,000 to the bond, and they succeeded. And these bonds have a stated rate of 10% annually. And for the 100th time, let me remind everybody, when you see a rate on a bond or any kind of business transaction, it is for a year. It represents a year. 10% times 10,000 is 10,000 per year. The bonds mature in 10 years, so you're going to pay 10,000 a year, but you're paying it semi-annually. You're paying it on June 30th and December 31st. Okay? Let's see what we have here. At this point, I just want to see something here. Yeah, I wanted to back up here because I didn't quite finish my thought here. The stated rate is 10% and the market rate is 10%. There is no premium or discount. You will get exactly $100,000 from the market. You will debit cash. You will credit bonds payable, a long-term liability. And then you don't have to do anything for 10 years. 10 years from today, you'd have to pay back the $100,000. Of course, you're making those interest payments of $5,000 every 6 months. And here is the journal entry, to record the interest payment. Interest expense, debit, cash credit. And that's going to be true for the 3 different scenarios we're going to run through here. Whether there's a premium, whether there's a discount, that doesn't change. The coupon rate is the amount that you pay. That's our 5,000. That's our 10% of 100,000 divided by 2. And now 10 years have gone by. Wow, we're all the way out to, in this case, 2025, huh? 2025. I'm hoping by then my beloved Rutgers University wins the national championship in college football, but that's very unlikely. But anyway, 2025. We pay the bond back. We credit cash and we debit that liability. Pretty easy, right? If it's a bond issued at the market rate. But let's talk about bond now. A bond, we are issuing the same bond at the same rate, same maturity date. Everything's the same except the market rate is 12%. You're trying to borrow money.
What are we on? We're on something
Oh,
called.
can somebody mute themselves? I'm hearing a voice there, if you don't mind. Thank you. What we're doing is here, we're issuing bonds, and we're willing to pay 10%, but the rest of the market is paying 12. So we are not going to get $100,000 for that bond. That the difference between the 100,000 and the cash we actually receive, we are going to call that a discount. Okay, it's a discount. The issue price of a bond, two pieces to a bond, a principal and an annuity. 12% is the market rate, paying it twice a year. So that would be 6%.
Somehow we're working backwards, I guess. That sometimes they give you like the total amount that you're going to pay at the end of say 3 years or whatever. But I haven't figured it out. Like I just haven't quite. So.
Are you asking a question? Somebody's talking. Okay. Bonds issued at a discount. We are not going to get the 100,000. So here's what we have to do. And this is the guts of the project there. I need the people who are talking to please mute themselves, if you don't mind. If you have a question, let me know. Thank you. Bonds issued at a discount. We have to figure out the principal, the present value of the principal, the 100,000, and the interest, and we add them together. Now here we go with the guts of the chapter. The market rate is 12%. That is the rate we use to access the present value table. So here we go. The principal is $100,000. You go to your present value table for the appropriate period. In this case, it's 20 periods. Periods are simply the number of payments we make. It's not necessarily the year. It's not necessarily a month. It's the periods, the number of payments, right? So $100,000 principal to be repaid in 10 years at a market rate of 6 is $31,180. $31,180 is what that money is worth today. That principal in 10 years is equal to $31,180 today. We have to have in the bank $31,180 now to grow to $100,000 in 10 years. So we just figured out the principal portion. Now we have to do the second part, the annuity. This bond pays doesn't pay. Forgive me for using that word. The market rate is 6%. So again, we go to the annuity table, the other table, and it's very easy to make a mistake by going to the wrong table. So let's, be careful with that. Although once you do make that mistake, you'll see you're all screwed up anyway. You'll be able to fix it, I think, but save a little time. So here we go. We have a market rate of 12% being paid semi-annually, so it's 6% for 20 periods. The present value of that annuity is $57,350, making 20 $5,000 payments twice a year over 10 years at 6% equals this amount. We need $57,350 in the bank now, and that would allow us to have the equivalent of making these $25,000 payments, okay? So here's our little template.
Anyways, I'm gonna sign out of this. Lunch is over. Thanks. See ya.
Bonds issued at a discount. We have to, this template here is real important, I think, okay? You should write, when you're doing your homework for this chapter, write this in front of you or have this slide in front of you or print it out or something. Because to come up with the issue price of bond, you have to get the present value of the principal. That was the 31,180 plus the present value of the annuity, or you're calling it interest, 88,500. Wow. We wanted to borrow 100,000, but we only got 88,530. Okay. That's less than the face amount. So clearly we are issuing this bond at what's called a discount. A discount. The present value of the bond at the beginning is the issue price, and there's a better word for it, I think, called cash. We are only going to get $88,530 in cash. Cash. We only get that much cash, and sadly, in 10 years, we still have to pay back the $100,000. The difference is called a discount. Like I said before, it's a contra liability account. And this difference of $11,470 must be amortized over the length of the bond. So let's talk about that. But before we do, that discount will be amortized over the life of the bond. And there's two methods we'll discuss: straight line effective interest. One is correct, one is really not. Both are acceptable, I guess, gap-wise, as long as they're reasonably close. And we'll talk about that. So here's the balance sheet, huh? Bond payable. Bonds payable. What was that bonds payable, huh? $100,000. You see this line here, bonds payable? That is always going to stay $100,000. What's going to change is the discount as we amortize. So here's your presentation on the balance sheet. You're going to show the entire 100,000, and you're going to show as a reduction whatever the balance is in that discount. This becomes the, in this case now, the issue price of the stock. It's also called the net book value of the stock. Just like the net book value of an asset is 100,000 we paid for the machine and we depreciated at 11,470. It's the same idea here. Okay? Same idea. We are now going to amortize using two methods. One is, I'm not going to say one is easier than the other. I think they're both equally challenging, but not terribly so. Amortization. We got to know what the discount or premium is. And since we're using straight line, we're going to take that number, whatever it was, 11,470, and divide it by 20. The number that you get when you do that is your total interest expense. And I emphasize the word total interest expense because that interest expense is not going to be the same as the coupon expense of 5%. This total expense is going to be the amount of payment you make plus the amortization. Another way to say it is amortization is the process, in this case, of turning a discount or a premium into interest expense over the life of the bond. Because that's what a discount is. It's really interest that was front loaded, but the proper treatment is we must amortize it over the life of the loan. And the discount or premium has to be zero at the end of the bond period. So this number here on the bottom on your balance sheet will be $100,000 in 10 years. So let's take a look. The discount was 11,470, 10-year bond, paying twice a year. 11,470 divided by 20 equals 574. We're going to reduce this discount with a credit every month. Look at your journal entry, your original journal entry. Every month we are going to credit bond and discount on bonds payable, the contra liability account. And what are we going to debit? Guess what? Interest expense. So let's understand this. Under straight line, we take the original, in this case, discount of 11,470. We divide it by the periods, which were 20. And every 6 months, we're going to write this journal entry. We're going to debit interest expense for 5,574. Where did we get that number? We have to pay the $5,000 of interest. That's the 5%. And this 574 represents the impact of the difference between the stated rate and the market rate. So your total interest expense is the cash payment plus the amortization. And look at your balance sheet after 6 months. That $100,000 number is not going away, but that discount is gradually being whittled down to zero over a 10-year period, okay? Say hello to your Bible. Look at this. Understand it. Have it available when you're studying. This is the flow, okay? We issued a bond for $100,000. We have to pay $100,000 back in 20 years, huh? But we only received $88,530. We only received $88,530. Wow, what a bummer. Well, let's see. We still have to pay $5,000 every period. So there's your interest payment expense, huh? We know that we have to amortize this discount with a debit to interest expense. Here is your amortization. We add these two columns up, that's your total interest expense. And you're going to write the same journal entry every 6 months, just as you see it here, okay? Straight line method, easy, just like straight line depreciation was easier than, say, double declining balance, right? Straight line depreciation is easy, but it's not really proper because you're not really matching up the correct liability at each point in time. Where I worked at Thomas and Betts, we had some things that were being amortized, and we were using straight line, and the auditors would come in, and what they would do was they'd say, show me your amortization stuff. And what they would do would run it through their system and compare it to the proper method, the effective market rate. And inevitably they come back to me and said, you guys are not quite right, but it's not material, so we'll let you go. Okay? Straight line, easy, but not quite proper. This is the proper method. This is the proper method, not straight line. Theoretically preferred. I say definitely. And you're going to compute the interest rate by multiplying the unpaid balance times the market rate. I'm going to pound that into our skulls in a moment, okay? And the difference between this calculation and the cash is going to be the amortized amount. So let's take a look at this. Effective interest method. Guess what? We borrowed $100,000. We only got the famous $88,530. We know we have a 10-year maturity and a $5,000 payment. Using the effective interest rate, your interest every period is the net book value of the bond by the coupon rate. I can't say that enough or emphasize it enough. Under this method, the net book value of the bond multiplied by the coupon rate, which I believe is 6% here, equals your total expense. So let's take a look at this. Yeah, it was 12% or 6% a period, huh? Your original net book value, which is also called the issue price, which is also called cash, huh? Cash. multiplied by 12% gives you 5,302. That is your interest expense. That is your interest expense. Net book value times, in this case, the 12% divided by 2 gives you your interest expense. We know the cash is 5,000. Here is the amortization for the first period. So your 11,530 goes down to that number there. And we are now going to take the next year's book value, and here's where we're going to review our little table here. 88,530 book value times 12% divided by 2 equals 5312. That's our total interest expense. It consists of 5,000 in cash, and any difference is the amortized discount. Book value, 88,530 to begin. That's how much cash we got. Minus the 312 gives us a new book value of 88,842. 88,842 times 12% divided by 2 is 5331. So our total expense is 5331. Again, we subtract the cash. There's our amortization. Notice what we're doing here. We are reducing the discount until it goes down to 0 after 20 years. And look what we're doing with the book value of the bond. It's growing, it's growing, it's growing. And at the end of 20 years, it must equal $100,000. Note also that your expense is different every month, every period, every payment period, okay? 5312. The amortization expense is going up. Why is it going up? Because the net present value of the bond is going up. These numbers are the net present value of the bond at those periods in time, okay? And at the end of 10 years, we got to get this up to 100,000, okay? Zero coupon bonds, I'm not going to talk about that too much other than to tell you what it is. This is a bond where you give the money and they don't pay any cash. You don't collect any interest payments. You give them 100,000 today, and then in 5 years, 10 years, they pay you back with all the interest backloaded on it. I don't know too many people who buy these things. Usually you get a better interest rate though. It just means you're not going to get 5,000 a period. You're going to get, maybe it'll end up being 5,300 a period, but you're going to have to wait 20 years to get paid. All right, now let's talk about the reciprocal of a discount, and that's a premium. It's a liability account, huh? Burlington Northern Santa Fe Railroad issues 100,000 in bonds having a stated rate of 10% annually. The bonds mature in 10 years. Allow me to take a snort here. That's good whiskey. BNSF issues 100,000 at 10%. But look here, the market rate is 8. That means people are going to go crazy. They're going to be lined up outside our trustee's office to buy our bond. They love us. We're paying 25% more than the market rate. And by the way, if that actually happened, it would cause all kinds of economic havoc. None of it good. But for purposes of understanding this chapter, we're making the differences significant. The real players with these interest rates are the big investment houses, the big banks, who look at those interest rates almost minute by minute, and as soon as there's the slightest tick, they go in and they flash trade and make a little bit of money. I know you don't have time to read now, but Michael Lewis, wonderful writer, both of baseball and business, he wrote the baseball book Moneyball. He also wrote the book The Big Short, which was a terrific movie. and he wrote a book called Flash Boys, and it's about that whole market structure where these guys have these powerful computers and the interest rates click for 2 seconds and they make money. Bond issued at a premium. Again, it's the same calculation, huh? We have to take the principal, 100,000, and now the market rate is no longer 12%, it's 8%, so we're gonna use 8%. Go to the present value table. Go to the present value table. It's 4% because they're paying out twice a year. So here we go. $100,000 times whatever the present value conversion is equals 45,640. So that's part of the issue price of the bond. Now the bond pays 10%, I believe. Yeah, it pays 10. See, I almost made the mistake I warned you guys about. You never use the payment when you're talking with the present value table. No, the market rate is 8%, so we're going to go in with the market rate, and here we go. We're going to make $25,000 payments for the next 20 periods. There's your conversion, 67,952. So let's fill these numbers in. What was the present value of the principal? It was 45,640. What was the present value of this? 67,952. Take a look at this now. The present value of the principal, the 100,000, was that amount. The present value of the annuity, the interest payments, the 20 payments of 5,000 will be that number. That's how much cash we're going to receive. We're going to receive $113,000 plus. Now take a look here. Here you have the bond payable of 100, but now we're adding the premium. We're adding the premium to get the issue price, the net book value of the bond. When we get to the amortization table, you're going to see that we're going to be reducing the bond. And forgive me, I got a little happy fingers here, it looks like. Let me get back to where we should be. Let me get back. There we go. I got to wear mittens or something. I get too feisty with the fingers, huh? Okay. At the end of the first period, we are using straight line. We're back in straight line. We divided that 13,592 by 20, and we came up with 680. 680 is the interest. But it's not really interest expense in this case, it's really interest income. When we receive that extra 13,592, that's interest income, really. It just needs to be spread over the period of the loan through the amortization process. So here we go. That's what we like to see, huh? The cash is always going to be the 5,000. We multiplied, didn't multiply, but we divided out the 20 periods into the original amortization amount, the original premium, and we got that. And here we're going to reduce that premium by 680. Notice your interest expense is less than the cash payment. That will be the case when you issue a bond at a premium. On your test, you will see questions like, they'll give you the particulars, and then they'll say something like, what was the interest expense for the second year? Don't make the mistake of just giving them the cash interest, unless they're asking specifically for that. Your total interest expense in this case, the first 6 months was $4,320. And again, let's take a look at our table. Whereas before, we started off with 98,000 and added, here we are decreasing the net book value as we decrease the premium. Straight line, $680 every 6 months for 20 years. The payment expense, the coupon expense, the coupon rate is always going to be the 5,000. This minus this equals this. Book value goes down by the amortization, goes down 680, 680, 680, goes down 680, 680. That's what makes the the straight line method a little bit easier, huh? Okay, now let's have fun with the proper method again. The effective amortization rate. Okay, here we're paying 10% when the rest of the world, I guess, was 8, we said, right? So here we go. Remember this formula again. Total interest equals net book value times the market rate. Net book value times the market rate equals your total interest. And you're going to have a different amortized number and a different principal every period, okay? So we went into our table at 8% divided by 2. We went in there 8%, 20 periods. We multiplied that by the original issue price, the cash we received. And here is our journal entry. Cash, 5,000. You notice that cash number never changes. That's the only time we use that coupon rate, just to calculate the payment to the borrower, to the lender, rather. We calculated this number above. Right here, the difference is going to be your interest expense. So this 456, you could argue it's interest income. And yeah, it really is. We're using but overall, it's interest expense, okay? The key thing to remember is that simple formula. Net book value times market rate equals the interest expense total for that period. Here we go. When you're taking the test, have this kind of information in your mind, huh? In your mind. We are taking the net book value in this case, and we're going to go reduce, 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 and reduce here. But because we're using the effective interest rate, the amortization goes up every year, and our interest expense goes down every year because the liability is going down every year. So let's do a couple of years together here. Book value, 113,592. 113,592. They didn't present it there. Okay. 113,592 times 0.08 divided by 2 gives us our total interest expense. 113,592 times market rate gives you that. Here is our amortization. And we got that by subtracting 5,000 minus the 45. Our premium has now been reduced. Net book value, 113,136 multiplied by the market rate equals 45.25. We amortize 112,661. You get the idea. Effective interest rate. This is the proper method because each of these balances for each of the 20 years is the actual net present value of that debt instrument at that point in time. Okay? That was a big part of this chapter. Bonds, don't be afraid of them. I think they're interesting. And I kind of like doing these little tables, actually. But then again, I'm kind of a nerd, right? And I'm not sure this thing is much use, but it's just a visual. You sell it at a premium, guess what? Your principal will go down eventually. You sell it at a discount, you didn't get 100,000. You have to work your way up to the 100. And of course, if it's at everything's at par value, you have nothing to amortize, huh? Let's talk a little bit about early retirement of debt. Remember, we went over the different kinds of bonds, and one was a callable bond. A callable bond. That simply means that we, as the borrower, had a clause in our bond contract, in the covenant, in the debenture, that we can always pay off the bond anytime we want. And normally what happens is you just contact the borrower and you say to the borrower, I am going to call the bond. Here's my check for such and such amount of money. It will be $100,000 plus any unpaid interest accrued up to that point in time, plus a penalty, usually 1% or some stated amount, okay? Early retirement of bonds, huh? And we're going to compare whatever we pay for the call against the book value. And again, companies would do this in order to get out of paying high interest rates, which begs the question. I'm not sure why anybody would buy a non-callable bond, knowing that they could get repaid early and not collect that nice interest. And I think the answer is probably that a non-callable bond would pay a higher interest rate, and you might take the risk that they won't call it. And that is the end of the chapter. I'm just a little annoyed here. They did not show this journal entry, okay? The journal entry would be a debit to cash, and there would be a credit to the $100,000. And the difference would be a gain or loss on the call of the bond, okay? So that's our chapter. Callie, are you there?
Yes.
Do you have any questions?
No.
No, you usually have good questions, not today, huh? And why are you hiding, by the way?
Not yet.
You're still there, okay. Brad, what do you think?
I think I'm good. I don't have any questions.
No questions? Hi, Giovanni.
Hey, Bob.
Didn't get a chance to say hello. What do you think?
I'm good for now.
Okay, well, hopefully you're at a point where you can attack the homework, okay? You all know where to find me, right?
Yeah.
All right, should we call it a meeting?
I think
Guess
so.
we'll end it. All right, the friendly raccoon salute. Woo woo. We'll see you guys later. Bye-bye.
All right. See you,
Thank
Bob.
you.
Bye.
Bye-bye, Callie. Are you giving me the raccoon salute, Callie? Okay.